Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by Zach's Director of ETF Research and the host of her own podcast, the ETF Spotlight, Nina Mishra, to discuss the energy ETFs. So I love the ETF industry because they tend to jump on the bandwagon, whatever's hot, they go for it, whatever the trend is. So they've put out ETFs in cannabis, the cloud, AI, we have ESG, whatever that is going on. Whatever the other hot areas are, they jump in with a new way to trade on it. But I've noticed that they've been quiet on the hottest industry of the last 14 months, which has been energy. There are no new ETFs that have launched in the last year to try to cash in on this hot energy trade. We're mostly left with the oldies but goodies, including like the big flagship one, the Energy Select Sector Spider Fund, the XLE, as it's just commonly known as the XLE. That one was launched, according to Yahoo Finance, in 1998 during the start of the last energy bull market. So, Nina, what's going on? Why is the ETF industry so quiet right now on energy?
Hi, Tracy. You're absolutely right. So if you look at the recent ETF launches, you will see a number of ETFs tracking the metaverse. You have 3-4 ETFs, which are supposedly inflation protection ETFs. And then you have ETFs tracking all sorts of hot themes. But yes, no one is launching energy ETFs, though. Energy was the best performing sector last year, and it is the best performing sector this year as well. Now, there have been a couple of energy ETF launches here and there. For example, this year we got a 2x energy bull ETF. It tracks the oil services companies. The ticker symbol is ONG. And this is about a month old. And it has gathered only 5.4 million in assets.
That's it?
That's it.
5.4 million.
Yes.
Oh my gosh. Just so that people listening understands, that's nothing.
That's like nothing.
Penny. Oh my gosh. Okay.
So people are not launching energy ETF, and as you mentioned, those boring energy ETFs, the boring and the best, which are the best ETFs for long-term investors, they have in fact seen decent inflows this year, but. The energy ETFs, which are hotter, for example, NRGU, which was supposedly quite hot with Reddit traders in last year and in a part of 2020, that ETN hasn't seen a lot of inflows this year. USO, which tracks oil using oil futures, that has outflows, a little bit of outflows this year. So it's an interesting phenomena going on in the oil industry. So long-term investors, it seems, are still putting money in these ETFs like XLE that you mentioned and VD, the one by Vanguard. Those have seen decent inflows this year, whereas supposedly the trading products, they haven't seen much interest this year. And of course, we are not launching any new energy ETFs. One ETF that launched recently, and it got my attention because it is supposedly an ESG ETF, and it was launched by Engine Number One. Engine Number One is an activist investor, and they became famous because they won 3 seats on the board of ExxonMobil. So they launched their second ETF recently, which focuses on companies that are driving the future of this energy transition And I saw that Occidental is one of the top holdings in that ETF. So an ESG ETF has one of the oil companies as its top holding, but we are not seeing any oil or energy ETFs launch lately. And the main reason is that climate talk is cool. So we have seen so many ESG-focused ETFs launch in the past few years. And this year as well, we have seen a number of climate-focused and ESG-focused ETFs, but nothing targeting energy as such.
So what's the ticker on that engine number one?
So the ticker is NETZ. And engine number one has their first ETF is VOTE. So the VOTE ETF is basically like an S&P. It tracks an index which is very similar to the S&P 500 index, and but it uses your money for shareholder activism. Now, this company, this was a very little known activist investor, and they caught attention because, as I mentioned, they won 3 board seats on Exxon's board, and they were backed by BlackRock, and they are now driving the climate change strategy at Exxon. So Exxon, you must have seen there, Exxon is investing a lot in their carbon recapture technologies, and they want to become net zero by 2050, I think. So all that is being driven by those board members at Exxon, yes. So after this, Exxon was earlier planning to increase oil and gas production by 25% over the next 5 years. And after this proxy battle with engine number one, which was won by engine number one, then Exxon announced that they plan to keep oil output at the lowest level in 2 decades. They are not going to increase the output, and they will go net zero by 2050. And you must have seen a lot of, advertisements and other things by Exxon that they are investing so much in carbon recapture technologies and how they are changing the climate and all that.
Yeah, so I just looked at the top holdings of that ETF, the NETZ that you just mentioned, and GM is up there, Deere, then the Oxy that you mentioned, Visteon, Ford, Southern Copper Corp, that's like a miners, Alcoa, Canadian Pacific, Albemarle, and Tran Technologies are the top 10. So kind of an interesting mix, not necessarily what you might think you're buying if you're trying to transform climate. So yeah, that's interesting that they're now including some energy. They said energy is 5.3% of the fund. So some of them who are, trying to go new directions, innovate, are able.
Yeah, so engine number one is also pushing GM to invest more in the EV lineup. So that is why GM is also one of the top holdings in the ETF.
Yeah, that makes sense. So how much money has flowed into this ETF? Do we know?
It has about 70 million in assets, so much better than 5 million. And this is not even a month old. This launched on the 2nd of this month, so just 20 days old. So for a 20-day-old ETF, 70 million is not bad at all.
Yeah, I'm still stuck on that fact that there's only 5 million that has flowed in there. So normally, they've given some time horizon to actually grow the assets in these. But I remember you saying that you need at least 100 million, right, to actually continue running the ETF. Isn't that right?
Yeah. So if an ETF is not able to gather more than 50 million or 100 million would be a good amount, then it is not profitable for the sponsor to continue running that ETF. Now, the ETF that I mentioned is by Direction. So Direction is not a very big ETF sponsor, but it is a decently sized ETF sponsor for So for bigger companies, it is easier to keep running even the loss-making products. But if it is a small company, if it is an ETF which is sponsored by a newer provider, which has just about 3-4 ETFs, then it would be very difficult for them to run an ETF or continue running an ETF which has less than 50 million in assets. So in that case, the closer risk is very, very high.
Yeah, I see. Turning back to the other ETF you mentioned that's relatively newer, they have the NRGU that you mentioned. That's the big oil index 3-time leveraged. I love it. That one has 680 million already. I don't know how long that one's been around. But that one, because it's 3-time leverage, they only have 10 positions in the portfolio. And that launched in 2019, in April of 2019. So just before the pandemic. It was good timing for that one. So that one is among the most recent.
Yeah, this is a 2019. This is actually an ETN, exchange traded note, which doesn't hold anything, but it tracks an index, and it is like a promissory note to deliver the performance of that index. So as I mentioned, this was very popular with Reddit traders when oil had plunged just after the lockdowns, and after that it started rebounding. So they thought that this is very oil is very cheap, and they started putting money in NRGU. And in fact, NRGU, because it is 3 times an index of US oil and gas companies, so this was the best performing energy ETF last year, and probably it is the best performing this year too, because of the leverage. But investors should remember that leveraged ETFs are not meant for long-term holding. They are supposed to be trading or hedging instruments only.
Right. And you don't get things like a dividend or anything like that because they don't actually own the companies. Is that correct?
Yeah. Right. That's because the dividend is one of the main attractions of investing in oil now, because they have such juicy dividends, and they have been returning a lot of cash to shareholders in the form of dividends and share buybacks too. In fact, just recently I read a report in the Financial Times that 7 oil majors, including Exxon, Chevron, BP, Shell, they will be returning about 40 billion to shareholders through share buybacks this year, and that would be almost double of 20 billion of buybacks, which was in 2014. That was the last time when oil was trading above $100 a barrel. And this is the biggest share buyback since 2008, because, these ETF majors, the asset giants like BlackRock and Vanguard, they are pushing these oil companies to keep their production unchanged and return more cash to shareholders in the form of dividends and share buybacks. So dividends is one of the big attractions for oil investors now. Okay.
Let's talk a little bit about one of the other leveraged, I guess this one is probably an ETN too, the Direxion daily S&P oil and gas 2 times bull, the one with GUSH as the ticker, GUSH. That's a good ticker. This one launched in 2015, but this invests in like the swaps and all that stuff, right? So this sounds similar to the other ETN in that way, where you don't own the companies.
Yeah, so this is a leverage ETF. So this is not an ETN; it is an ETF. But in order to achieve that leverage, these leverage ETFs, they use a number of derivatives, including swaps, etc., to achieve that leverage. But and again, investors should remember that leverage products are meant for trading or hedging only, not for long-term investing.
So if investors are interested in getting into an ETF right now, should they just stick with the tried and true, the big granddaddy, the XLE? I know that covers the entire industry, including services, natural gas, all of that stuff. Should they try to do a more actively managed? I I'm not sure if some of these other ones, there's some small ETFs from Invesco that have a bigger expense ratio, like the Dynamic Energy EMP ETF, PXE is that ticker. They only have 132 million under management in that one. And inception was 2005, so they've been around a while, but that one is performing pretty good. What should they do? Where should we go?
So there are two ways to, kind of benefit from the rising oil prices if you believe that oil prices will continue to rise. So you can either invest in oil ETFs directly, and those oil ETFs are commodity ETFs, which use futures to track oil prices. So ETFs like USO, those are for tracking the commodity prices, and because they have to use futures, they cannot buy oil and store it. Gold ETFs are physically backed, or precious metal ETFs are physically backed because they actually buy gold and silver and they store in the vaults. But other commodity futures-based ETFs that track oil or corn or wheat, they are futures backed. So that is one way of profiting from the oil prices. But because they invest in futures, they hold futures, investors should remember that they can suffer from contango at times, though currently the oil market is in backwardation. And when it is in backwardation, it means that at the time of rolling over those futures contracts, there is a roll yield. But normally the futures market is in contango. So whenever those futures are rolled over, there is a roll cost. So that is something which investors should remember. And those ETFs should again be used for short-term trading or hedging only, the commodity-based ETFs, because they use futures. But if you are a long-term investors and you believe in the outlook for the energy industry as such, then I think these cheap ETFs that invest in oil companies like XLE or VDE, those are the best for investors. There are some by Invesco, as you mentioned, which are based on momentum. So if you think that the momentum could continue, is going to continue, then probably you can look at one of those momentum-based ETF too. But I think XLE and VDE, those are among the best for tracking the broader oil industry as such. So you mentioned that you are positive on energy. So do you think energy industry has, do you think that sector will continue to do well?
Yeah, I think it has a couple more years to run in this bull market, that we've entered into a new secular bull. So if I was, interested in it, we've had a nice run here to start 2022. And we might get a pullback here because it's been, pretty hot here. So I wouldn't be surprised if some traders take some of their gains off the table. But if they do, I would be looking to buy on any, significant weakness in the big names or in some of these ETFs. If you just want to own like the whole industry, basically. That's an easy way to do it, especially if you buy like the oil and gas EMP, the XOP. That's a pretty big ETF. That's been around a while. And that one will get you a lot of the kind of smaller, higher beta names. Like I took a look at the list there, what they own. Calon Petroleum is the top holding, SM Energy, then Occidental, then Diamondback. Those two are pretty big. And then Continental, which is also pretty big. But you're not going to get the big oils. You're not getting Exxon and Chevron with that ETF like you would in the XLE, and the Vanguard fund has those. I think if you look at the XLE, almost half of it is Exxon and Chevron now. So
yeah, it is very top heavy. So yes, as far as the outlook for energy industry is concerned, I think I'm also very positive now. I was in fact very late in getting onto that bandwagon because I always saw that ESG is such a hot theme, and particularly in the ETF industry, and all these asset giants. They were forcing companies to reduce their investments, not to drill, increase production. So I thought the outlook for energy industry is going to continue to be negative. And if you look at the returns over the past 10 years, the sector had underperformed so much, and it became such a small part of the broader indexes. But now it seems that everyone is talking about the transition, but the world is just not ready for that transition, right? And if you look at what happened at natural gas prices in Europe over the past year or so, they have jumped almost fivefold, because Europe was much ahead of the US in terms of climate change and the transition to green energy. So they stopped investing in their own fossil fuels industry, and they were heavily dependent on Russia for natural gas. So that is why all those supply disruptions are causing such a surge in gas prices in Europe. And probably that is also one of the reasons why the outlook for oil and energy industry looks good, because all these companies, they are not increasing production, even though oil prices have surged so much and they are making so much money. They are reporting record profits. If you look at the results of Chevron and Exxon, their profits were highest in almost a decade, but they are not increasing production. They are just returning money to shareholders or investing in green energy and carbon recapture technologies and such.
Well, I should have you on the podcast more often, because you can just give the whole scenario that I believe is going to happen for energy, because you just did right there. But yeah, I'm very bullish on the next several years, in fact, because usually the bullish cycles in energy do last for numerous years. So if you want to say this one began when the industry kind of bottomed out in October, November of 2020, right before the vaccines were announced, that was the worst, the darkest time, I think, for them. Then we're only really in like the second year of this newish type of supply and demand bull, which is bullish for the energies from what you just laid out. So yeah, it's going to be interesting to see what happens with a lot of these companies and professional money managers who don't want to be in this area because of ESG issues and climate change. But if this area stays hot, they usually don't stay on the sidelines forever in the hottest industry that's out there. So we'll see. But for those that are looking for dividends, this is a good time to be looking at some of these companies, because they are paying out all of this cash. I think it was Pioneer Natural Resources that said they're paying out 80% of their free cash flow. A couple of the others are anywhere from 60 to 70% so far they've announced. But with crude at these levels, even if they're hedging some of their crude and natural gas, they're still leaving some of it unhedged and, seeing just really strong profits. So yeah, this is an area I like a lot. People who are in my portfolios here at Zacks know this, because I own them in both the insider trader, because the insiders have been buying energy pretty much across the board since November of 2020. They've been going in full throttle. And I'm waiting to see if they do this earnings season as well, if they decide to buy any here, because it has been this nice rally. And it might be just a little too hot for even them to handle, but we'll see. They do like to wait for pullbacks. And there have been numerous pullbacks even since November 2020. There was a 20% sell-off in pretty much across the board in the energy complex last summer. So I do think we'll see that again. And especially, everything follows the crude and natural gas prices for the most part. So if WTI falls back, around 80 or so, that's still way above the budgets of most of those drillers. And so they're fine with $80, that they'll take $80, but the street will probably sell off the shares again. So you'll be able to get them cheaper at some point, and including these ETFs as well. So
since you mentioned that you have been positive on the energy industry, energy sector, and you have owned these for some time. So looking forward, do you think that these broader ETFs are better for investors, or should they focus on an ETF which holds only oil services companies or E&P companies? Are you more positive on a particular area within the industry?
Well, I still like the EMPs for the biggest gains. They have more upside always than the service side, which always kind of lags. They just don't have the same tie-in with WTI. That's not how they make their money. They will see benefits as WTI rises because usually that means more production. So that means more revenue for them. But the EMPs, the exploration and producers, they see a direct tie-in with, taking that oil or nat gas out of the ground and selling it at those higher prices. So I still like, if I was going to buy any of the ETFs, I would be the most interested in the EMP ETF, which is ticker XOP.
Yeah, and you mentioned the concentration in XLE. So for investors who are uncomfortable with an ETF being quite top heavy, then XOP is an equal weighted ETF. So there is not much concentration in that ETF, and pretty decent, pretty popular with investors. 4.3 billion in assets, and quite reasonably priced for its equal weighted ETFs. They are a little bit more expensive than market cap weighted ETF because they have to do more rebalancing. Okay. So this has an expense ratio of 35 basis points, which is, I think, quite reasonable for its strategy.
Good to know. And that ETF is up 11.5% year to date versus the S&P 500, down about 9% right now. So it's holding its own here in 2022. Okay, let me recap a lot of these tickers because we did talk about a lot of ETFs today, so it's a good mix. So that new ETF that just launched the 2 times, but it's oil services, is ticker ONG, if you're interested in the new guy on the block. Then we talked about the 3 times leveraged big oil index. That one is NRGU. That's the one that's up 74% year to date, but that's the Reddit trader guys on that one. Then we had engine number 1. They have that climate transformation ETF, but it includes some energy in there. That's ticker NETZ. Then we have just the good standby that's been around the longest, the XLE. We had a couple of those Invesco ETFs. They're in the game, but they're a little bit more momentum, as Nina mentioned. But there's the Invesco Dynamic Energy EMP ETF, which is PXE. So P is in Peter, XE. Then they also have a second one, Invesco WDA Energy Momentum ETF. That's PXI. So you might want to check out those. Then we talked about GUSH. That's the 2 times. And then we talked about Vanguard. That's just kind of the lower cost. Also, a lot of people are in that one. Maybe it might be in your 401k or that kind of thing. It's ticker VDE on that one. Vanguard's is V as in Victor, D as in Dave, E as in Edward. And then we had the EMP, the S&P Oil and Gas EMP ETF XOP that we were just discussing. So yeah, there's a good mix here. Take a look at some of the individual holdings. I always like to go look at the ETFs and see what the holdings are in there, and then maybe look around and do some research on them. All of these are owning relatively similar, other than the ones that are using swaps or the other things. But the big ones have, a lot of the same similar names and makeups, other than the one that's on just the EMPs or the one that's just services, some of those that are kind of more niche-y. But yeah, a lot going on. So you want to be sure to subscribe so you don't miss a single episode, because who knows what we're going to talk about next week. because there is a lot going on. So be sure to subscribe. You can get us on Apple Podcasts. You can get us on Spotify, Amazon Music, anywhere you can get the podcast these days. We are going to be there, and be sure to sign up because I'll be back next week with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.